Hi. In this lecture, I'll be talking about the stock pricing or valuation using free cash flow approach. As we know, there are different approaches, different models while calculating the stock price or stock value, like relative based model, cash based models. Relative based models are covered by almost 5 sub approaches, and cash based models, there are 3 different types of models, like free cash flow approach, residual equity cash flow approach, then adjusted present value APV approach. So in this lecture I will be just focusing on free cash flow approach. So free cash flow, first we have to understand what is free cash flow. Free cash flow, just focus on name. Free cash flows, it means the cash flows which are available to distribute among bondholders or shareholders. Bondholders are the debt providers and shareholders or equity holders are the equity provider are the shareholders. After meeting the requirements of business, so we can simply say free cash flows are the cash flows which are available to distribute among the bondholder, means debt provider, and shareholders, means equity provider, to meet the after meeting the business requirement. Why the cash flows, free cash flows, are distributed among bondholder and shareholder? Because the fund was raised, the financing was done. If the financing is done through debt and equity side, then obviously after meeting the business requirement, the free cash flows which are available to distribute, and these free cash flows are distributed among debt provider and equity provider, and these are the requirements of free cash flow. While we are talking, we must be having the data of these components. What are these components? Operating expenses, means cost of goods sold, then taxes, working capital, and capital expenditure. Capital expenditures are the investment in fixed assets. The investment in fixed assets, and the investment in fixed asset, it means we are going to acquire the real assets, and to meet the obligation or requirement of real assets, we need funds, and funds are raised from debt providers and equity providers. Obviously, after meeting the business requirement, the remaining amount is free cash flow, which is distributed among bondholder and stockholder. So free cash flow, its formula is free cash flow is equal to earning before interest and tax into multiply by 1 minus tax plus depreciation plus minus net working capital plus minus not net working capital, change in net working capital. Here is change, that is change in net working delta. Here is delta. I think I skipped here. Change in net working capital plus minus capital expenditure. So this, it's the formula, and why it's plus minus I will explain. When it will be plus and when it will be minus, I will explain in later slides. So how we can find the market price per share by using the free cash flow approach? Its formula is value of equity divided by number of shares outstanding, and as we know, the value of equity is the combination of, the value of equity is equal to the combination of the value of company is equal to the combination of value of equity plus value of debt. Value of company is equal to the combination of value of equity plus value of debt, and in this case, in this formula, we are required the value of equity, not value of company. So if we have the data of value of company and value of debt, then we can find the value of equity. So the value of equity is equal to value of company minus value of debt. Obviously, it's understood that the left side of the equation is assets and the right side of the equation is equity and debt. And value of debt, value of equity is equal to value of company. So in this case, in this formula, we are required the value of equity, and value of equity can be determined is equal to value of company minus value of debt. So uh, to fulfill the requirement of this formula, we must be having the value of equity divided by number of shares outstanding. So the value of equity is equal to value of company minus value of debt. And here we need the data or information or values of value of company and value of debt. Then we will be able to find the value of company. So value of company is equal to free cash flows multiplied by growth rate of free cash flow divided by weighted average cost of capital minus growth rate of free cash flows. This is value of company. If we have the to find the value of company, we must be having free cash flows into 1 plus growth rate of free cash flows divided by weighted average cost of capital minus growth rate of free cash flows. So here the free cash flows we can determine from this formula. Then we have to find the growth rate of free cash flows divided by weighted average cost of capital. So growth rate of free cash flows, so its growth rate, as we know, the time value of money, there are four components: future value, present value, interest rate, and a number of time periods. So it's the rate of free cash flows. So as we know, the future value is always equal to present value multiplied by 1 plus I raised power t or n. If we are required I, obviously, then future value divided by present value, then what will be left, what left on the right side of equation, that will be left 1 plus I raised power t. So we are required I. So after simplifying, the I is equal to, means growth rate of free cash flow is equal to future value of free cash flows divided by present value raised power 1 by t minus 1. Keep in mind the concept of time value of money. There are four components. Future value is equal to present value into 1 plus I raised power t. So if you are required to find the present value, then the formula is future value divided by 1 plus I raised power t. If you are required the rate of return, then the formula is I is equal to future value divided by present value raised power 1 by t minus 1. So in this case, we have to find the growth rate of free cash flows. So its growth rate, it means it's the rate of return. So it will be equal to future value of free cash flows divided by present value of free cash flows raised power 1 by t minus 1. So it's the formula like we calculate the rate of return. So weighted average cost of capital is weight of equity into cost of equity. So the overall financing is, I suppose, the 100%, out of 100%, how much is financed by the equity and how much is financed by the debt side. I assume if the debt equity ratio is 30 and 70, what does it mean? Debt equity ratio, debt is 30% and equity is 70%. It may vary from firm to firm. So weight of equity is, what is weight of equity? That is the how much proportion out of 100 is financed by equity side, and what's the remaining is financed from the debt side. Obviously, when firm is going to finance from equity side, there is also cost of equity. There is also cost of equity, and there is cost of debt. So the weighted average cost of capital is calculated through weight of equity multiplied by cost of equity, then weight of debt multiplied by cost of debt, which is denoted by KD. As we know, we have already discussed how they are represented and how they are presented and abbreviated in the formulas. So weight of debt multiplied by cost of debt and into 1 minus tax rate. 1 minus tax rate. So WE is weight of equity, WKE is cost of equity, WD is weight of debt, KD is cost of debt. So we can have the data of this weight of equity, weight of debt, cost of debt, tax rate, and cost of equity. How we can calculate the cost of equity? Here we can calculate from the CAPM formula, risk-free rate plus market systematic risk, that is beta. That is beta systematic risk multiplied by market risk minus risk-free rate. So this is formula. From this formula we can calculate the cost of equity. So cost of equity is risk-free rate plus systematic risk, that is beta, and multiply by market risk minus risk-free rate. So RF is risk-free rate and RM is market rate and beta is systematic risk. So here the choice of growth rate, we have two choices. One is cumulative average growth, cumulative annual growth rate. Second one is simple average growth rate. Simple average growth rate, cumulative average growth rate and simple average growth rate. It means if there are continuous increase pattern in the free cash flows, then we go for the cumulative annual growth rate. If there is the trend, if there is trend, sometime increase, sometime decrease, then we apply simple average growth rate. And growth rate will be calculated every year because there is a trend between every year growth rate, because it's increasing or decreasing. Trend means sometime it's increased, sometime it decreased, and that's why we calculate the rate on yearly basis. So if it's not having the trend, then we go for CAGR. So if there is no trend, means the cash flows growth rate is going at one side, so we can calculate, we can use the cumulative annual growth rate. This is an example. It's important to understand this concept. This is assumption based data of firm A, B, C, whatever the firm is. So we suppose firm A is the last 5 years data. So if you are going to calculate the 5 years on the basis of 5 years, then you must be having the 6 years. Then you must be having the 6 years from your starting point. From your starting point, I will explain why we take the 6 year, why the 6 years data is required if the T is 5 years. So company A in 2010 the EBITDA is 5,000, in 2012 EBIT is 5,500, then in 2012 it's 6,000, 2013 again 6,000, 2014 it's 5,800, and 2015 that is 7,000. And there is a straight line depreciation all the years. I assume it's assumption based data, not the real data, and the depreciation is 500 over the life of all years. And here is the capital expenditure. Here is the capital expenditure. What is capital expenditure? It's long-term investment. And long-term investment, what is long-term investment? And what is long-term investment? That is acquisition of real assets. So in 2010 it's 600, 2011 600, 2012 500, and so on. So keep in mind the concept. What is concept? If what we have required, keep in mind here we are required KE, risk-free rate, systematic risk, market risk. market risk data. From here, we can calculate WACC. For WACC, we need weight of debt, weight of equity, weight of debt, weight of equity, cost of debt, and tax amount. And from here, we can calculate the growth rate of free cash flows. We must be having the data of these all components, then we will be able to find the value of company, free cash flows of current year into 1 plus growth rate of free cash flows divided by weighted average cost of capital minus growth rate of free cash flows. So here from previous slide, here we will be able to find the value of equity by if we have the value of company and value of debt, then we can find the value of equity, and value of equity is used to determine the market price per share, and its formula is value of equity divided by number of shares outstanding. So come to the example. The EBIT is given, depreciation is given, capital expenditures are given. These are the requirements of the formula. So if the net working capital is 10% of EBIT and taxes 30% of EBIT and taxes 30% EBIT, it's assumption based data. I have assumed these values. If risk-free rate is 5%, KD is cost of risk-free rate is 5%. If cost of debt is 10%, and market risk is 15%, and value of debt is I suppose that's 22,000. Then the systematic risk, that is 1.5. Debt to equity ratio is 40. Debt to equity ratio is 40/60. It means 40% is debt, 60% is equity. So the weight of debt is, if we convert into decimal, it's 0.4, and the weight of equity is 0.6, and growth rate of free cash flow is 5.3%. Tax is also given, that is 30%. The time period is 5 years. So the present value of future cash flow is 3700. How we calculated the present value and future value, and future value of free cash flow is 4780. As we know, always the future value is greater than present value. Excuse me. Share outstanding in the markets are 1000. So here I will explain these parts. As we know that future value is always greater than present value. Why we took the data of 5 years. So if I am required to find the change in net working capital. From next slide, the things will be more clear. It's the data, EBIT, same data, depreciation is given, capital expenditures are given. Here is the net working capital, which is 5%, 10% of EBIT. EBIT 10% of 5,000 is 500, 10% of 5,500 is $550, whatever the unit of currency is, 6,000. 10% of 6,000 is 600, and next is 6,002 is the 10% of 6,000 is 10%, and in 2014 EBIT is 5,800, and the net working capital is 580, and in 2015 the EBIT is 7,000, and the 10% of 7,000 is 700. Here we have to find the change. That is important. Why we use the 6 years data. If time is 5 years, then I assume it's starting from 2011 to 2015. Then I must be having the data of 2010. Then how will be able to calculate the change? So I am required the change in 2011. So 5 years starting from 2011 to 2015, these are 5 years. But to find the change in net working capital, I am required the data of one more previous year. So the one previous year is to 2010. What is net working capital in 2010? That is 500, and the net working capital in 2011 is 550. 2011 is 550. Here we are going to find the change. How we can find the change? Delta NWT is equal to net working capital of current year, because we are going to determine 2011, so it's current year and it's previous year. So the 550 minus 500, that is $50. What is plus $50? Whatever the value is, it can be dollar, it's rupees, and whatever the unit is, we can place here. So for next year we have to find the change in net working capital in 2012. So current year 600 minus 550, the value is 50. Then again in 2013, the value of net working capital is 600. There is no change. It's current value, it's previous value. The difference is 0. We place 0. In 2014, the net working capital is decreased. So it's the current year and its previous year. So the value is minus 20. In 2015, the net working capital is increased. Its value is 700, and it's the preceding year, that is 580. 700 minus 580, that is the positive value, which is 120. Now here we have to understand where we put the positive sign, where we put the negative sign. Change in net working capital formula is current net working capital minus previous year net working capital. As we know, the free cash flows are equal to EBIT. Free cash flow is equal to EBIT into 1 plus tax plus depreciation plus minus change in net working capital, not only net working, change in net working capital, and plus minus capital expenditure. Then here is that it's important to understand. Look, we are going to calculate free cash flows. Free cash flows, just keep in mind the definition. Cash flows which are available to distribute among debt providers or equity providers, and after meeting the business requirements. If we look at here, 2011, in 2011, the change in net working capital is positive, 50. It means this 50 is the business requirement. Then the free cash flow value will be decreased, because first this 50 is change in net working capital, because in previous year it was required 500. This year it's required 550. So 50 is extra. So obviously it's positive value. The free cash flow will be having less free cash flow, because it's the business requirement. After meeting the business requirement, then we have the free cash flows. If it's positive, then it's in formula we will place it as a negative, because it's increased the value after meeting the business requirement. Then the value of free cash flow can be determined. So last year it was 500. This year it's 50 is extra. So obviously the free cash flow will be decreased. It will be we will subtract it from the overall calculation. Two simple words. If change in net working capital is positive, then we subtract it from formula. Here it's positive. Once we calculate the free cash flow, it will be, we put the negative is 0. That will be no change. If it's negative, last year the net working capital was 600. This year that is 580. It means you have extra $20, because free cash flow will be increased. When it will be increased, if we add it in the formula. Simply we can say, we can understand, if change in net working capital is positive, that will be subtracted in the formula. If it's negative, that will be added in the formula. How? Why? The logic is that free cash flow is the money which is free cash flows are the cash flows which are distributed among debt providers and equity providers after meeting the business requirement. Look at here. Last year in 2014, net working capital was 580 and in 2015 is 700. 120 is increased, and this is the business requirement. To meet the business requirement over $120, then you will be having the free cash flow. Obviously it will decrease the free cash flow. So simple words, when net working capital is positive, we will subtract in the formula. If change in net working capital is negative, we will add in the formula. Capital expenditure, this is expenditure, business expenditure, so it will be again subtracted in the formula. This is expenditure subtracted in the formula, expenditure subtracted in the formula. So look at the formula. 1 minus tax, 1 minus tax, so tax is also going to subtract. Then you will be having the free cash flows. Okay, in this example, in this slide, we simply transform the tables, the rows into column and column into rows. Same components: EBIT, depreciations, capital expenditures, net working capital, change in net working capital. We simply transform. We place these components in rows, and the year will be in column. In next slide, simply we transform EBIT of 2010 5000, 2011 500, 5050, and so on. Same amount, simply EBIT. That was in previous slide, it was in column. Here we are going to transform into rows. Here are taxes, tax, EBIT minus tax. Okay, so tax, that was the 30%. That was 30% of EBIT. So 30% we can calculate here. 1 minus tax, and its value is 5000. So its tax is going to minus, subtracted in the formula. That's why when we put in the parenthesis, it leads to subtraction, and if it's not parenthesis, that is we will be going to add. So tax amount of 5,500, 6,000, 6,580. These are the tax amounts, and we put into bracket. It means they will be subtracted. Depreciation in the formula, that's going to be added, so that will be plus, and we will place here. So change in net working capital, look at the previous slide. To calculate the change in net working capital of 2010, we must be having the value of 2009. If we don't have the data of 2009, then we put the dash here. Okay, here in 2010, change in net working capital is no value. Then in previous slide, in 2011, it was positive value. That is the after meeting the business requirement. If it's positive, change in net working positive, then it will be subtracted in the formula. So that's we placed it under the parenthesis. So the same is the concept in 2012. That was positive plus 50. Here will be subtracted, and the next year is 0, no change, because net working capital of 2012 and 2013 was same, and in 2014 the net working capital was decreased. That was the change was the net working capital was decreased by $20. So obviously it's negative. Here we will place as a positive. We will add here, and 120 in the previous slide, that is change in net working capital of 2015 is positive value. When once we put in the formula, it will be negative. What is logic? I have explained in detail. So capital expenditure, that is the business requirement, and we are calculating free cash flows after meeting the business requirement. So these all expenditures will be subtracted. Okay, so we can't calculate because we don't have the value of change in net working capital here. We have 5 years, time is 5 years, so obviously we'll be starting from this point. After simplifying, 5000 minus 1650 plus 500 minus 50 minus 600, the sum is 3700. In 2012, the free cash flow is 4150. Free cash flow in 2013 is 4200, and free cash flow in 2014 is 4080, and free cash flow in 2015 is 4780. So we have calculated the free cash flows. We have calculated the free cash flows. Look at here. We are required the growth rate of free cash flows. What we have to find? Growth rate of free cash flow. Growth rate means we have to find the I, future value, divided by present value raised power 1 by t minus I, minus 1. So same concept we will apply here. Why we calculate the free cash flows? What is this? This is our base year, means earlier money is the present value, later money is the future value. So we have the data from 2011 to 2015, 5 years, 1 2 3 4 5. So this is present value, this is the future value. Present value is always less than the future value. So growth rate of free cash flow formula is, as we know, future value of free cash flow, because this is free cash flow. This is free cash flow. This is the present value of free cash flow. It's the future value of free cash flow. The present value is 3700, and the future value of free cash flow is 4780. That's why I put these values here. Present value of free cash flow is 3700, and future value of free cash flow is 4780. Then we can calculate, and we have the number of time periods. We can simplify and calculate the growth rate of free cash flows. So look at here, 4780, that is the future value. 4780, that is the future value of free cash flows, divided by present value of free cash flows raised power 1 by t, and time is 5 years, starting from 2011 to 2015 minus 1. After simplifying, we have calculated that after simplifying we obtain 0.053. If we convert it into decimal, into percentage, that is 5.3%. Growth rate of free cash flow is 5.3%. So look at here in the formulas. So here we have the value of free cash flows. Here we have the value of free cash flows, and here we have the free cash flow and growth rate of free cash flows. So we move forward. After calculating the growth rate of free cash flows, where it's used, then its growth rate of free cash flows. Then we can find the cost of equity. Cost of equity. Cost of equity is risk-free rate plus systematic risk beta into market risk minus risk-free rate. Do we have the risk-free rate? That was 5%. Systematic risk was 1.5. And market risk was 15%. So after simplifying, this is KE. KE is 20%. Cost of equity is 20%. If cost of equity, then we can find the weighted average cost of capital. Then we can find the WACC. As we know, the WACC formula is weight of equity, cost of equity, weight of debt, cost of debt, multiplied by 1 minus tax. So keep in mind the given data. What is debt to equity ratio? debt weight of debt is 40%, means 0.40, and weight of equity is 60%, 0.60. So do we have the here the cost of weight of debt, weight of equity? Here the value of cost of debt is also given, that is 10%. All values are here. So we can find the WACC. We can find the WACC. So weight of equity is 0.60. Cost of equity is cost of equity. We just calculated here from the CAPM. So here the cost of equity is 0.20 minus cost weight of debt is 0.40. So cost of debt is 10%. 1 minus 0.30, that is tax rate is 30%. 1 minus 0.30. So the WACC is equal to, if we simplify it, that's equal to 0.12 minus, if we multiply 0.04 multiply by 0.10, its value is 0.04. If we simplify 1 minus 0.3, so it's equal to 0.70. So the overall WACC is 0.092. It means 9.2%. Weighted average cost is 9.2%. That is the overall cost of capital, which is the combination of cost of equity, cost of debt, and weight of equity, weight of debt. And we, not combination, we can calculate the WACC by using this information. And in this question, it's 9%. So we have calculated WACC, we have cost of equity, then we have the growth rate of free cash flows, we have the free cash flows, and then what's left? We can find the value of company, and value of company can be determined the formula free cash flows into 1 plus growth rate of free cash flows, then WACC minus growth rate of free cash flows. So do we have the value of growth rate of free cash flows? Yes, we have calculated. We have calculated. And WACC, we have calculated. Free cash flow. Free cash flow. Which free cash flow we will consider? Obviously, we are going to calculate the market price per share, and the prices are present value. Prices are present value. Obviously, we will consider the value free cash flow, this value, not this value. Market price we are going to determine in 2015, okay, not this value. So we will be very careful. We will be consider the free cash flow of latest year, latest free cash flow, okay, while calculating the value of company, because here we will be having the value of company, and at this point we have to find the fair price, market price at this point. So we will be considering the free cash flow of latest year. So we can calculate from this formula the free cash flow of latest year is 4780 into 1 plus growth rate of free cash flow is given. We have calculated, and the value weighted average cost of capital, back value is 9.2% and minus 1. After simplifying or calculating, the value of company is $1,29,060, whatever the unit is. As we know, value of company, we have calculated. Value of debt, data is given, that is 22,000, and value of company, as we know, value of company is equal to value of equity, value of debt plus value of equity, and here we have to find the value of equity. Obviously, the value of company, if we subtract the value of debt from value of company, that equates to value of equity. The value of equity is 1,07,060. 1,07,060. So everything we have calculated. Then we can find the market price per share. By using free cash flow approach. Formula is value of equity divided by number of shares outstanding. So value of equity is 1,07,060. How we calculated? Value of company and value of debt. After simplifying, we obtain this, and value of company is calculated from this formula: free cash flow into 1 plus growth rate divided by WACC minus growth rate of free cash flows. And which cash flow we will free cash flow we will take into account while calculating the value of company? That will be the most recent year free cash flow. In our example, the most recent year is 2015. Because why? Well, we use the most recent, and we have to find the market price per share, fair price. Obviously fair price is now, we are going to find now, and it's the most recent year, that is 2015. So obviously we'll be considering free cash flow of most recent year. Same, we calculated the WACC from the formula by using the value of weight of equity, cost of equity, weight of debt, cost of debt, multiply by 1 minus tax rate. So we can calculate the WACC, and by using the formula of CAPM, we calculate the cost of equity, and here we can find the growth rate of free cash flows. Present value divided by future value. Most recent free cash flow is represented by future value, and the starting year free cash flow is considered the present value, and we have the formula, and we have simplified the by this formula and we can find the growth rate of free cash flow. So here market price per share, as we know, the formula is value of equity divided by number of shares outstanding. The market price per share is value of equity is 1,07,060. Outstanding number of outstanding shares are 10,000. 1,000. The market price per share is 107.6 $107.6, whatever the value is. It's the fair price by using the free cash flow approach. But one is fair price, second one is H price, means at the price the stock is traded in the market. So you can check the difference. Either if the fair price is greater than the market price per share, means traded price. One is fair price. If fair price is greater than the market price per share, the market price on which the stock is traded, it means it's undervalued. If it's undervalued, we normally buy the stock. If the fair price is less than market price, the price which share is traded, then that is called overvalued. Actual worth is, I suppose, it's the fair price. If in the market it's 150, so it's overvalued. Here it's undervalued. Once it's overvalued, we sell the stock. This was all about the stock valuation by using the free cash flow approach. So in next lecture, I will discuss the bond evaluation, and if I find time, then we'll be discussing the rest of models to calculate how we calculate the fair price by using different models. Thank you very much. Stay blessed.